20%. That's the share of the world's entire daily oil supply that stopped flowing 48 hours after February 28, 2026. Not slowed down, not redirected, stopped. And if you think that number is just some abstract geopolitical headline that affects oil prices and nothing else, I need you to stay with me for the next 20 minutes. Because what's happening right now in the Strait of Hormuz isn't just an energy crisis. It is the single most powerful catalyst to hit silver in a generation, and almost nobody is talking about it correctly. Here's the thing. Silver is sitting right around $85 an ounce as I'm recording this. It touched $85.16 just last night according to JM Bullion's live pricing. And the mainstream narrative is, war bad, safe haven good, prices go up. That's technically true, but it's about as useful as telling someone there's turbulence on an airplane without mentioning that one of the engines is on fire. Because this Hormuz closure isn't hitting silver from one direction. It's hitting silver from 5 directions simultaneously. And when those 5 forces converge, and I'm going to show you the documented data on every single one of them, that's when you get the kind of price move that history only records a handful of times per century. By the end of this video, you will understand exactly why $84 to $85 silver is not the ceiling of this move. Why the COMEX data is flashing warning signals that haven't been seen in the history of the exchange. Why the Hormuz closure actually destroys the bearish industrial demand argument that silver skeptics keep making. And why Iran's newly appointed Supreme Leader Mojtaba Khamenei, whose first public statement was delivered just hours ago on March 12th, just threw gasoline on a fire that was already burning out of control. Let me build this case for you from the ground up. On February 28, 2026, the United States and Israel launched Operation Epic Fury, coordinated airstrikes on Iranian military facilities, nuclear sites, and leadership infrastructure that resulted in the death of Supreme Leader Ali Khamenei. Within 48 hours, the IRGC, the Islamic Revolutionary Guard Corps, did exactly what they'd been warning they would do for years. On March 2nd, a senior IRGC commander confirmed the Strait of Hormuz was officially closed. They struck the U.S.-flagged tanker Stena Imperative in Bahrain, killing a port worker and wounding 2 others. They attacked the Athenova with drones, and over 150 tankers anchored outside the strait, their captains staring at the 21-mile-wide choke point and calculating whether their ships were worth dying for. By March 5th, war risk insurance had been pulled entirely. That's not a small thing. When insurers, the people whose entire business model is pricing risk, decide a passage is uninsurable, shipping companies don't go through it. It doesn't matter what the cargo is worth. It doesn't matter what the contract says. You cannot move a $150 million tanker through a war zone without insurance. Maersk and Hapag-Lloyd, 2 of the largest maritime shipping companies on the planet, have already suspended Middle East routes. The strait has gone from 70% traffic reduction to effectively 0. That's 13 million barrels of oil per day that just vanished from global supply chains. According to Kepler, the energy consulting firm, that represents roughly 31% of all seaborne crude flows in the world. Now here's where it gets important for silver, and I want you to really lock in on this next part. Quick message before we go deeper. My analytics show that about 3 out of 4 people watching right now aren't subscribed. If this kind of data-backed analysis is cutting through the noise for you, if you're tired of headlines and you want the actual numbers, hit that subscribe button. That's how I know who the committed community is. It helps the channel, and it tells the algorithm to show this to more people who need to understand what's happening right now. Okay, back to the data. Here's what most silver analysis gets completely wrong when a geopolitical event hits. They treat silver like it's a single-purpose asset, a safe haven that goes up when fear goes up and comes down when fear comes down. But silver is not gold. Silver is a hybrid. It's roughly half safe haven asset and half industrial commodity. And the most important thing to understand about the Hormuz closure is that it doesn't just boost the safe haven side of silver's demand profile. It simultaneously attacks the supply side, disrupts the industrial ecosystem in ways that paradoxically increase silver's value, and triggers inflationary pressures that make every existing holder of paper currency want hard assets. Let me break each of those down with the actual data. Force number 1, safe haven demand. This is the obvious one. When the U.S.-Israeli strikes hit Iran on February 28th, gold briefly spiked to $5,423 an ounce. Silver exploded to $96.40 intraday on March 2nd before pulling back sharply, a 7% intraday crash that flushed out the weak hands, and then stabilized in the $85 to $93 range, as documented by Disruption Banking's market analysis from that date. Right now, as of March 12th, USA Gold is reporting silver at $85.12 and gold at $5,110. The gold-silver ratio has tightened to 59.6 to 1. For context, that ratio was near 80 to 1 a year ago. When the ratio compresses like this, it's telling you something specific. Institutional money is moving into silver as a primary position, not as a secondary afterthought. Force number 2. This is where the analysis gets really interesting, and it's where most people completely miss the story. The Hormuz closure is disrupting the solar supply chain. I know that sounds counterintuitive. The logic people use is this: if energy gets more expensive, industrial production slows down, and that means less demand for silver from manufacturers. And that would be true if we were talking about, say, 1985, when silver's primary industrial use was photographic film. But we're in 2026. According to the Silver Institute's most recent data, industrial fabrication now accounts for a record 680.5 million ounces of annual silver demand. And the fastest-growing segment of that industrial demand, solar photovoltaic manufacturing, is being hit by the Hormuz closure in a very specific and counterproductive way for anyone hoping silver prices come down. Here's why. The World Economic Forum published an analysis this week specifically about the Hormuz disruption's effect on clean energy. Their finding? Higher fuel costs, higher feedstock costs, higher insurance and freight costs are raising production costs across the industrial system, including for solar panels. Now you might think, more expensive solar panels means fewer solar panels, means less silver. But that's wrong. Because the supply of silver going into the solar panels is also being disrupted, not from the solar side, but from the shipping and logistics side. China tightened silver export licenses beginning in January 2026, according to Uni-Athena's commodity analysis. And now, with shipping routes through Hormuz effectively closed, the rerouting of raw material supply chains around the Cape of Good Hope adds 2 to 3 weeks to every voyage and increases freight costs by 40 to 60% per container. That means the physical silver that industry needs is harder to source, slower to arrive, and more expensive to transport, while demand from the energy transition continues at full speed. The Silver Institute projects a market deficit of approximately 149 million ounces for 2026. That's the 6th consecutive year of demand exceeding supply. The Science Direct Research Journal published a peer-reviewed study this year showing that by 2030, silver supply may only meet 62% to 70% of demand, with solar alone consuming between 29% and 41% of annual supply. A single photovoltaic panel contains 15 to 25 grams of silver. A single electric vehicle uses up to 50 grams, roughly twice what a conventional car uses. These numbers don't go down because of a war. They go up because the war is accelerating inflationary pressure that pushes governments harder toward energy independence and domestically produced solar power. Force number 3, inflation. And I want you to really sit with this one because it's the force that the Federal Reserve and the Treasury Department are probably lying awake thinking about right now. Goldman Sachs economists published an analysis this week. Their names are Manuel Abacasis and David Maracle, and they raised their 2026 U.S. inflation forecast by 0.8 percentage points to 2.9%. They trimmed GDP growth by 0.3 percentage points. And in the more extreme scenario, oil prices averaging $110 a barrel for March and April, they see inflation hitting 3.3% and GDP falling to 2.1%. They also raised the probability of a U.S. recession this year by 5 percentage points to 25%. Oxford Economics went further. They modeled a scenario where global oil prices average $140 a barrel for 2 months, and they found that would push the Eurozone, the UK, and Japan into contraction. It would create economic standstill in the United States. Iran's new supreme leader, 56-year-old Mojtaba Khamenei, appointed just this past weekend on March 9th after his father's assassination, made his first public statement just hours ago, on March 12th, and he didn't offer any olive branches. According to Bloomberg's reporting updated at 2:49 p.m. UTC yesterday, Khamenei explicitly stated that the Strait of Hormuz should remain closed as, quote, a tool to pressure the enemy, and warned that if fighting persists, other fronts in Iran's conflict with the U.S. and Israel will be opened. He also told the United States that every military base in the Middle East would be attacked if they weren't shut down. Oil prices extended their gains following that statement. When a nation's new supreme leader opens his first public address by promising to expand a war, you're not looking at a situation that resolves in 48 hours. Analysts at CNBC are now reporting 3 more ships have been struck in the Persian Gulf, and Iran has made clear that Oman's alternative routes, through Duqm and Salalah, are not safe either. Drones already struck fuel storage in Duqm, Sohar has been declared a war risk zone by the Joint War Committee of the London insurance market. Saudi Arabia is trying to reroute oil through the Red Sea via Yanbu. Japan has asked its government to release emergency oil stockpiles. The IEA, the International Energy Agency, has taken the unprecedented step of agreeing to release 400 million barrels from global reserves. But here's the mathematical reality. 400 million barrels sounds like a lot until you realize the strait was moving roughly 13 million barrels per day. That's about 30 days of buffer, assuming perfectly smooth logistics, which never happens. Force number 4, and this one is not on anybody's mainstream radar. This is the COMEX situation. And I want to walk you through this carefully because this is not conspiracy theory. This is documented exchange data you can verify yourself at the CME Group's website. Let me give you the baseline first. COMEX, the commodity exchange in New York, is where silver futures contracts are traded. A single standard contract represents 5,000 troy ounces. Most of these contracts are never actually settled in physical metal. Traders roll them forward, take cash settlement, or close their positions before delivery. That's been the norm for decades. The system works as long as most participants trust that the physical silver exists and could be delivered if requested. Now look at what's been happening. According to a detailed analysis of CME delivery data, COMEX registered silver inventory, that's the portion that is immediately deliverable against futures contracts, stood at 240 million ounces back in April of 2020. By February of 2026, that number had fallen to 86.13 million ounces. That's a 64.1% decline. As of March 9, 2026, the goldsilver.ai COMEX tracker shows registered inventory at 78.5 million ounces and continuing to fall, with a depletion estimate of approximately 62 trading days at the current withdrawal pace. The paper-to-physical ratio right now? 7.4 times. For every 1 ounce of silver that physically exists in deliverable COMEX inventory, there are 7.4 ounces worth of paper claims outstanding. Now here's the part that matters enormously. January 2026 saw 49.4 million ounces of silver delivered through COMEX. To put that in context, that is 7.27 times the level of January 2024, in a month that is historically one of the quietest of the year for silver deliveries. February 2026 continued the trend with 25.18 million ounces delivered, the highest February delivery volume in modern COMEX history. And that data, from Seeking Alpha's detailed analysis of the February numbers, describes what happened as, and I'm paraphrasing this carefully, a market in backwardation, facing high demand, record prices, and metal leaving the vault at a rapid pace. The analysts specifically noted that metal leaving the vault was not flowing into the eligible category. It was leaving the exchange entirely. That means it's being taken by industrial users and institutional investors who don't trust the paper system to deliver when they actually need it. The Seeking Alpha piece described this condition as raising the risk of physical supply stress if vault holdings fall below 50 million ounces. We're at 78.5 million ounces now, and falling at roughly 785,000 ounces per day. Do that math. Stick with me because this next part connects everything together. In January 2026, before the war even started, there was already a signal that something was fundamentally breaking in the silver market. London lease rates for silver spiked to 34.9% on October 9, 2025, with intraday peaks touching 39.2%. Normal lease rates are below 1%. When lease rates go to nearly 40%, it means someone is paying a massive premium to borrow physical silver on an emergency basis. That kind of rate doesn't exist in a market where metal is plentiful. That rate exists in a market where dealers are desperately sourcing metal they don't have. According to the detailed Substack analysis at Jinlo by researcher David Jensen, who tracks CME delivery data daily, COMEX has delivered 86.4% of its current registered inventory in just 60 days, while simultaneously facing new delivery demand. He called it the highest 2-month delivery rate in exchange history, and he made a critical observation. Speculative positioning has collapsed by 77.72% year over year. Managed money contracts went from 54,415 in February 2025 to just 12,121 contracts in February 2026. The speculators have left the building. The people demanding physical silver now are not gamblers. They are industrial users who need the actual metal to build solar panels and EVs and AI data centers. And they are institutional investors who looked at the Hormuz situation and decided that holding a piece of paper promising silver delivery is not the same thing as holding actual silver. The disconnect between the paper market and the physical market is now visible to anyone who looks. The paper market has silver priced at $85. Meanwhile, dealers are reporting elevated physical premiums. In India, now the world's largest importer of refined silver according to Macquarie, with $9.2 billion in imports in 2025, physical demand has not slowed down despite prices nearly tripling in rupee terms. The London silver market, where lease rates hit 39%, is being drained. Shanghai Gold Exchange inventory fell to 10.24 million ounces in early February, a level not seen since 2015. Which market is telling the truth? The screen that says $85, or the physical market where metal is disappearing faster than at any point in recorded exchange history? Force number 5. And this is the one that transforms all of the previous forces from serious to potentially historic. The fertilizer shock. I know, you came here for silver and I'm talking about fertilizer. But bear with me for 60 seconds, because this directly affects everything I've told you about inflation. And inflation is the most powerful driver of silver investment demand. Fertilizer represents roughly 1/3 of global fertilizer trade that transits the Strait of Hormuz, including large volumes of nitrogen exports. That direct quote from supply chain expert Daryl Fletcher at Bannockburn Global Forex, appearing in CNBC's reporting on March 11th. New Orleans fertilizer hub urea prices have already risen from $475 per metric ton to $680 per metric ton. Fletcher himself said, and I'm paraphrasing, "Not great timing for the planting window in the Midwest for soy and corn." If Hormuz disruptions persist through the spring planting season, you get food inflation layered on top of energy inflation. And food inflation is the kind of inflation that doesn't respond to Fed rate hikes. It doesn't respond to Treasury statements. It responds only to actual physical supply returning to the market. And what do people, and central banks, do when they face a combination of oil price inflation, plus food price inflation, plus manufacturing disruption, plus geopolitical uncertainty with no clear end date? They buy real assets, gold, silver, commodities. Not because of any particular analysis, but because hard assets are the oldest insurance policy in human history. Let me put the historical context on this, because this has happened before. Not the exact scenario, but the exact structure. The convergence of a geopolitical supply shock with already stressed physical inventories and a paper market that has lost connection to physical reality. In 1973, the OPEC embargo cut off roughly 10% of global oil supply. Silver was trading around $2.50 an ounce at the start of that year. By 1974, it had hit $6.70, a 168% move in under 18 months. Then, in 1979, when the Iranian Revolution cut oil supplies again, and gold and silver went into full-blown mania, silver went from roughly $6 an ounce in early 1979 to $49.45 on January 18, 1980, a 724% move in less than 12 months. Now, I am not here to tell you silver is going to $600 or any particular number. What I am telling you is that every single time in modern history when a major oil supply disruption has collided with an existing physical metal supply deficit and elevated inflation expectations, the silver price has responded with moves that catch the majority of investors completely off guard. The current setup is arguably more structurally tight than either 1973 or 1979. In 1973, COMEX registered silver inventory was not declining at 785,000 ounces per day. In 1979, there was no solar photovoltaic industry consuming 30% of annual silver supply. In 1973 and 1979, China was not tightening silver export controls. The structural deficit that existed before the Hormuz closure was already the 6th consecutive year of demand exceeding production. The war didn't create the setup. It lit the match next to a pile of dry wood. Now let me make this practical. What does this mean for you, right now, watching this on March 13, 2026? First, understand the two-sided risk. Silver's 40% crash in early February, from $116 down to $70 in less than a week, should be tattooed on every investor's memory. Silver is not a gentle asset. It gives you violent corrections even within secular bull markets. We saw $96 intraday on March 2nd, then we came back to $82 to $83 range by March 5th, and now we're consolidating around $85. The fact that we're consolidating in the $83 to $86 range after a war started is actually more bullish than the spike to $96. Because consolidation at elevated levels means the market is absorbing the shock and building a base, not just spiking and retreating. Second, understand the timeline variable. This situation resolves in one of three ways. The US and Iran reach a ceasefire or some kind of negotiated pause, in which case silver likely retreats but holds much of its gains because the structural deficit doesn't go away. Iran's new leadership cracks under military pressure, highly unlikely based on every historical precedent for revolutionary theocracies, and explicitly contradicted by Khamenei's statement yesterday about opening new fronts. Or the situation drags on for months, in which case the inflation, supply chain disruption, and physical demand story compounds with each passing week. Third, the COMEX situation deserves your attention. The delivery data is not something to dismiss. At 78.5 million ounces of registered inventory, with a 62 trading day depletion estimate, and the April contract's first notice day just 13 days away, the market is entering a period of maximum physical stress. If delivery demand in April matches anything close to the January and February intensity, and there's no reason to think it won't given the Hormuz backdrop, the eligible to registered conversion pressure is going to be extraordinary. Keep watching the CME's daily warehouse reports. You can access them directly at cmegroup.com under Delivery Reports and Metals Issues and Stops. When registered inventory starts approaching 50 million ounces, you will know that the physical market pressure is entering a critical phase. Fourth, watch the gold-silver ratio. It's at 59.6 to 1 right now. In previous major silver bull markets, this ratio has compressed to 40 to 1 or lower. At today's gold price of $5,110, a ratio of 40 to 1 implies silver at $127 an ounce. At a ratio of 50 to 1, that's $102 silver. These are not predictions. They are mathematical relationships that have existed throughout precious metals history. Fifth, watch oil prices. If crude breaks above $110 sustained, Goldman Sachs already told us their inflation forecast goes to 3.3%. If it breaks above $140, Oxford Economics' breaking point scenario, you will see a flight into hard assets that makes the current move look small. The IEA's 400 million barrel reserve release buys time. It does not solve the problem if Hormuz stays closed. Sixth, monitor the Oman bypass situation. Right now, Saudi Arabia is attempting to reroute some crude through the Red Sea via Yanbu. The UAE and Oman have theoretically viable alternative routes, but the drones that struck Duqm and Salalah and the war risk designation of Sohar have already shown that Iran is not going to let alternative routes develop without contesting them. As long as Iran's new supreme leader is making statements about expanding the conflict, every alternative route is a potential target. Seventh, and I want to be completely clear that none of this is financial advice. I'm not a financial advisor, and silver is one of the most volatile assets on the planet. If you are positioning in silver, understanding whether you're holding physical metal or paper claims is not an abstract philosophical question right now. It is a practical one. COMEX data and London lease rates are both telling you that the people closest to the actual metal are treating paper claims and physical possession as two very different things. So let's bring this full circle because I started with a number and I want to end with a number. 20% of global daily oil supply. That's what closed when the Strait of Hormuz went dark on March 2nd. And then I told you I'd show you exactly how that single event hit silver from 5 directions simultaneously. We've established that safe haven demand is real and documented. $96 intraday spike, then consolidation at $85 as I record this. We've established that industrial demand disruption actually tightens silver supply chains rather than reducing silver's value. We've established that COMEX registered inventory has fallen 64% since 2020, is being drained at 785,000 ounces per day, and is 62 trading days from potential critical stress, all before a single Hormuz-driven demand shock. We've established that Goldman Sachs economists are forecasting 3.3% inflation in extreme scenarios, that the fertilizer supply chain is already breaking down, and that food inflation could layer on top of energy inflation in a way that has no quick monetary policy solution. And we've established that Iran's new supreme leader made his very first public statement about expanding the war and keeping Hormuz closed just hours ago on March 12th. People living through the 1973 oil embargo didn't wake up one morning and say, "This is the moment that changes silver's trajectory for the next decade." They read the newspaper, they watched the evening news, and most of them went about their lives. The few who understood the structural intersection of supply shock and monetary inflation and hard asset scarcity were positioned for one of the most powerful wealth transfers of the 20th century. The signs are in the data. The COMEX reports are public. The delivery numbers are on the CME's website. The lease rates are tracked. The geopolitical situation is on every front page. The question is never whether the information is available. The question is whether you look at it clearly enough to understand what it means. Drop a comment below and tell me this. Do you think the April COMEX delivery period will be the real pressure test for the physical silver market? Or do you think the Hormuz situation resolves before it reaches that level? I read every single comment. Your thinking shapes what I analyze next. If this video gave you a clearer picture of what's actually happening, beyond the headlines, subscribe, hit the notification bell. And the next video I'm publishing covers the gold-silver ratio compression in detail, using every major historical precedent from 1979 to 2011 to map out where this ratio could go and what it implies for both metals if the Hormuz closure extends past 30 days. This isn't financial advice. It's documented data. What you do with it is your decision.